Alright guys, so we are just about done with this quarterly roundup of stocks that big investors are buying, but I had to include Steve Cohen here once again because the legendary stock picker just spent literally hundreds of millions of dollars on 5 different stocks, 4 of which were brand new additions to the portfolio, with the 5th one being also a 1600% increase. So massive buying here from Cohen and his giant hedge fund Point72 Asset Management. It's one of the biggest hedge funds in the entire world, so we gotta take a look at these moves here. I'll give you my thoughts on each one of them. It's actually a pretty good list of stocks here. I'll be frank with you, very interesting picks here, and I'm gonna rank them from best to worst too based on my opinion. So hit that like button if you're enjoying these stock roundups that big investors are buying. It lets me know you want to see more of these videos and I'll be happy to make more for you. But let's just go ahead and dive straight into this list. Now, starting here, we're going to sort these from these 5 purchases from smallest to largest position in the portfolio relative to each other. And purchase number 1 is going to be Global Payments, ticker symbol GPN, which was a new addition to the portfolio at over $200 million worth of stock being purchased just in that quarter, and it was still only worth less than 1% of the overall portfolio, because that's how big they are. Now, if you've never heard of this company here or the stock, well, GPN is of course a payment processing company that basically facilitates the transactions between not just customers and merchants, but also business to business, as well as offering additional services and add-ons as well, including payroll and more. Therefore, it's a fintech that is notably benefiting from the gradual shift in finance towards digital payments, which is a market that nearly doubled in size during the pandemic years. And even now moving forward, it's just a general trend that will very likely continue, with analysts expecting it to add another $6 trillion of transaction value over just the next few years, according to Statista. Now, as a result of all this, well, GPN's sales have been steadily rising for years, and although their profits have been a little shaky at times, they've mostly been trending upwards too, with last year in particular being a record year for both the top and bottom line. The only concern though that Wall Street does seem to have right now is just how much growth can still be experienced in future years, which not only have tough comparisons to the pandemic years, which might have been more favorable to online digital sales and payments, right? But the other concern is that the market is also just being too heavily saturated at the moment, with all kinds of rising competition showing up now. Now, a lot of these companies that I'm about to show you, they're not all direct competitors, perfect ones, as many of them have different characteristics, different makeups to their business and what they specifically do themselves. But you're still talking about many large companies in the digital payment space, including recognizable names like PayPal, Stripe, Square, Venmo, Shopify, and Cash App, as well as giant behemoths like Google, Apple, Alibaba, Amazon, and more. Again, while they may not all be perfect direct competitors, they're all basically giant fish within the same lake, and over time, they could start to eat away at each other's market share depending on how it all plays out. And because of that, well, sales are now only expected to rise for GPN by a mid-single digit rate in each of the next upcoming 2 years. On the bright side though, this actually caused the stock to lose almost half of its entire value from the top, leaving behind a very cheap valuation for a fintech like this, with a PEG ratio that is 35% cheaper than the sector. Now, part of that is also due to their earnings per share expected to actually rise by a double-digit rate on average over the next 5 years, and that helps that valuation actually be a bit lower because of that earnings growth, because of that profit growth. Now, my only concern though is, can their revenue growth keep up with that? Might the revenue growth slow down that they seem to perhaps be experiencing? Might that also take a little bit of a toll on their earnings growth in the future as well, given the very saturated market, which, to be fair, I think they're doing a great job of still competing there, and they have already managed to attract millions of merchants and customers to their platform, servicing over 100 different industries worldwide. So they definitely have some moat, they definitely have some brand recognition that I think is strong. And I also think that it's just really impressive, everything that they're doing and how they're running the business. And that shows in their relatively strong financials. So given that, plus the overall growth of the market that I do expect to get even larger over time, plus the cheap stock price, I actually do consider this stock to be overall a buy. However, the only reason why I'm not buying it myself, at least not at the moment, maybe in the future, but the only reason is because I already own so many different stocks that give me plenty of exposure to the digital payments markets, including PayPal, Alibaba, Tencent, Google, Apple, Amazon, and more. And most of those are much larger and much more diversified companies that I feel are safer overall investments as well. But I'm still ranking GPN pretty high here because, like I said, I would give them an overall buy rating, especially if I didn't have the stock, if I didn't have those other stocks instead. But I'm going to put them pretty high at number 2. I'm going to give them the number 2 ranking because of those pros I mentioned. All right, let's see what else is on this list though. Well, moving on to purchase number 2, we have another brand new pickup from Cohen, a really interesting one at that, and that is Comcast, ticker symbol CMCSA, which was almost a $225 million purchase just in the quarter alone. And look, when it comes to Comcast, I do have a few immediate thoughts on this one. I actually looked into them a couple times in the past, but I just couldn't convince myself to ever pull the trigger on this stock because, similar to what I just said with GPN, well, with Comcast, I just feel that there are better, more diversified stocks out there like Disney, Google, Apple, Amazon, and more that, you know, also give a ton of exposure to media, but also do many other things too, are more diversified, more profitable, and stuff like that. But I will say that when it comes to Comcast stock, it actually does look very attractive for a couple reasons. First of all, they own many large media properties like NBC and Universal, which Universal as a film studio alone actually held the #1 market share in North America just last year, even ahead of Disney, Warner Brothers, and Paramount. And while they still have a lot of their business going to cable TV along with internet, well, that content that they are able to produce through their properties has helped them fuel their new video streaming platform, Peacock. Plus, they also have a large theme parks business with Universal Studios, for example, in Hollywood, and they also have one out in Florida. Well, those have been growing in popularity, especially recently thanks to the addition of Nintendo World that has been very popular through that partnership. But like I said, many of these areas have a lot of competition, as is the case for their Peacock streaming service that only ranks 7th in subscribers, just barely ahead of ESPN, and is way behind other giants like HBO, Paramount, Disney, Amazon, and Netflix, some of those having over 100 to even 200 million more subscribers. And that's part of the reason why their growth has been a bit stagnant in recent years, because their markets are just getting so heavily saturated these days, and that stagnant performance is even expected to continue over the next 2 years as well. The only reason why I do still think this stock is very interesting though is because it's at least fallen by close to 40% from the pandemic highs, leaving behind a dirt cheap valuation on virtually any metric you look at. And because their profits continue to grow, usually at around a high single-digit rate per year, well, they're able to also pay a pretty nice dividend of over 3% of a yield, which also carries a low enough payout ratio to where I think it's probably safe here as well. So maybe for a value dividend type of investor, I could see why they might want to take a chance on something like this, but I just think longer term, the returns will be a bit mediocre in my opinion, or at least compared to the other stocks that I think are much better. So even though I think it's a decent enough stock, can't really rank it too high. I'll be nice though. I'm going to put them at number 3 because of that cheap valuation and the somewhat attractive dividend, but I definitely can't go any higher than that. Moving on to the next purchase though, we actually have an oil and gas giant in ConocoPhillips, ticker symbol COP, which was also another brand new addition by Cohen worth just over $225 million. Now this one though, I'm not as big of a fan of as perhaps the others, and it's not because I have anything against Conoco. I actually think they're a pretty good kind of pure play on the energy market, especially of course in oil and gas, if that's what you really want. But there's two reasons why I would personally choose an alternative stock instead. First reason is I just think that there's going to be more stable future growth and potential with a more pure play in renewables. My favorite of which being Next Era Energy, who I also own already myself. But there's other options too in that space as well. Whereas oil and gas, I expect to continue being quite volatile in the future, and we can already see some of that with Conoco's financials over the years, having many periods of significant declines with also very large rises. But trying to time all of that just kind of gives me a headache, and I think it'd be tough to keep track of. And while I certainly acknowledge that the company is very profitable with a strong dividend and even a well-performing stock price in recent years, I would actually prefer a different oil and gas giant in Chevron instead. I don't own it, but I like the fact that they have a cheaper valuation with also a better dividend. Conoco, for example, yields over 3% on 3 consecutive years of growth, while Chevron yields over 4% on more than 3 decades of consecutive growth. And yet, again, they have the cheaper valuation. So whether it's in a different type of energy or within the same type of energy market, I would prefer a different stock myself regardless. And that's why ConocoPhillips is going to have to get the number 4 ranking at the bottom. It's not that it's a bad stock, again, but it's just one that I'm not very interested in myself, at least not at the moment. With that said though, we are now down to the final 2 largest purchases of the list, and coming in at number 4, we actually have one that I am becoming much more interested in lately, and that is the legacy computers maker Dell, ticker symbol DELL. How long has it been since you guys probably considered this one? But this one's pretty interesting here. It wasn't quite a new purchase for Cohen, but it was a 1,600% increase up to almost $330 million. And yeah, when it comes to Dell, like I said, I think most people don't really talk about this company a whole lot these days. They used to be pretty well known for making computers, especially more affordable ones. It was something similar to like HP, for example. But more recently, I actually think that they've done a very good job of diversifying, at least as much as they can, into other areas like data center creation, cloud computing, cloud storage, where they actually ranked number 1 in enterprise storage by the IDC. That might surprise you. I know it surprised me a little bit. And they also offer many associated services like their new Apex platform that offers higher efficiencies at lower costs. And they even do a lot of work in AI now too. Not just through all the things I mentioned already, but also in various other services, and they're integrating it into their new PCs as well, which could help drive sales for those Dell PCs. And overall, all of these different moves, different things, I feel will help them remain relevant in a more competitive landscape over the longer term, and that's a good thing. Like, for example, you look at the number of hyperscale data centers skyrocketing last year because of the rise in AI. Well, Dell plays actually a major role in that. In fact, they're even helping Elon Musk's xAI build the largest supercomputer data center in the world, what they call Colossus, used to train Grok, which it already houses over 100,000 NVIDIA H100 GPUs, and it's expected to double in size by next year too. That's pretty crazy. And again, Dell is a major beneficiary from that work, providing server racks and other components to these projects. Unfortunately though, being a legacy PC player coming off of the pandemic highs, last year was actually a significant decline for the company in revenue. But those diversification initiatives that I mentioned earlier should help them bounce back up to around a double-digit growth rate, with EPS also expected to deliver similar results over the next 5 years, whereas the previous 5 were actually negative. And that's why most analysts are now very bullish on the stock and have even been raising price targets over the past year or so. Unfortunately though, as most of you know, the market tends to be forward-looking and has already priced in much of these gains, with the stock rising by over 300% over the past 5 years. However, if we zoom in a bit, we can see that from the recent highs, the stock has actually dipped in recent months, falling by almost 40%, which also leaves behind a dirt cheap valuation that is around 40% cheaper than the sector on most metrics. I know it's been a lot of back and forth on this stock here that I've been giving you, but I'm actually, I would say overall, fairly bullish on Dell stock at the moment. I think that it is looking pretty attractive at these levels, which, by the way, it also pays a nice little dividend too. But regardless, when ranking it, it's going to be a very tough one to rank. I feel like they're very tied with GPN. I would go with either one of them at this point, but I'm going to give GPN just a very slight edge here and bump them up to number 1 to fit Dell in right behind them at number 2. That's kind of just what my gut is telling me, but again, I feel like they're very close. With all of that said though, we are now left with the 5th and final purchase, which is the largest of the list, at least, in relation to these ones, and that is none other than Apple, ticker symbol AAPL, which, like the others, Cohen added the stock as a brand new position last quarter, buying up over $330 million worth. Now, this one did surprise me a little, given that we recently had some other giant investors like Warren Buffett and Ray Dalio actually selling the stock recently, which I made a whole video about. And my theory is that they did this mostly because of how much the stock has climbed recently and to lock in some profits. Not only with Apple stock trading at a record high right now after climbing by close to 800% over the past decade, but it's also the most highly valued company in the entire world at over $3.3 trillion of a market cap, which puts me in an extremely difficult position trying to rank this stock on the list, because on one hand, I feel like the valuation is significantly higher than the sector on virtually any metric you look at, and that's not very attractive, while revenue growth appears to also be a bit limited at their already massive size, with last year in particular actually being a slight decrease. But on the other hand, this is one of the largest, most profitable companies in the entire world that will see it doing over $400 billion and $100 billion in sales and profits next year alone, with revenue growth also expected to reaccelerate pretty close to a double-digit %, likely thanks to the new additions of AI and even the prospects of folding phones coming in the near future too, which all of that I do feel will convince consumers to upgrade their handsets. The additions of different AI services and features, and again, if they once they do make folding phones, which I know are coming. So because of that, and several other pros too, like the fact that they have one of the biggest cash reserves in the world, that they can easily choose to deploy that into any new market or growth initiative whenever they feel like it, not to mention the high margin growth that they see in their services for an extremely sticky ecosystem, as well as the billions they pour into stock buybacks year after year. Overall, it just makes Apple an extremely difficult stock to bet against. So I guess I have to give them the number 1 spot here by default. I'm not happy about it. I'm not buying any Apple stock myself at these levels, although I do already own some. But in terms of long-term safety, it's just a stock that a lot of people like to hold on to. So I kind of have to go with that ranking. But let me know if you agree with this. Would you put Apple at number 1? Or do you think that GPN or even maybe Dell might offer a bigger perhaps buying opportunity, maybe, obviously higher risk, but perhaps more reward potential if they can kind of turn things around or perform well longer term? I don't know. I'd love to hear your thoughts. Maybe you think those are laughably, much worse companies and stocks that shouldn't even be compared to Apple. I don't know. I'd love to hear your thoughts. Personally, I think number 1 to number 3, the way I rank them, I think they're very tied, but they have different unique characteristics, so it would depend on what type of investor you are or what you're looking for specifically to how you might rank those. But anyway, thanks for stopping by, my friends. I want to hear your thoughts down in the comment section, and I want to thank you for all your support. It means so much to me, and I will catch you in the next video. I hope you're all doing well. All right, take care, my friends. Have a good weekend. Have a good next week. I'll catch you in the next video. Take care, everybody. Bye-bye.